Down 23% in 2022. Is Lowe's an excellent dividend stock to buy for 2023? Let's answer that question in this video. The first thing I'm going to look at is Lowe's quarterly revenue growth going back to before 2014. And you can see a few things here in this chart. For one, you can see the absolute explosion during the pandemic. Home improvement spending was one of the surprises during the pandemic. People staying home, looking around their house, decided that they needed to paint, they needed to add an outdoor barbecue space, they needed to add a home office. All of these things caused home improvement spending to explode, and Lowe's and Home Depot, for that matter, benefited from that trend. However, that's moderating as you might have expected. It slowed down in recent quarters, but still positive, growing 2.5% in its most recent quarter. If you look longer term, Lowe's has been able to grow its revenue at a compound annual rate around 7% over the last decade. Lowe's and Home Depot, for that matter, have done an excellent job at protecting their business from encroachment from Amazon. The type of stuff that they sell makes it more likely that you're going to want to go into the store to buy it than buy it from Amazon or one of its competing e-commerce sites. So that's a good fact for investors that are looking to invest in Lowe's for the long term, that you can feel like the business is somewhat protected from the industry, is somewhat protected from the outside e-commerce players. The next thing I wanted to look at is operating income, and Lowe's has done a really good job expanding its operating income. In fact, its operating profit margin has also been expanding at that time. So not only is the total operating income rising, but its operating profit margin is rising as well. Of course, fluctuations due to the seasonality of the business, but overall, if you look at the highs, it's higher highs and lower lows, and that's really good news for investors looking to buy Lowe's stock for the dividend yield. And so let's look at the cash flow from operations. And similarly, you see upward trending cash flow from operations. A little bit of trouble in the near term as sales have came down and as it needed to really overinvest in inventory to make sure that it had the product on hand because of so many supply chain shortages. Of course, when you pay money for inventory, that reduces cash from operations because that's a use of cash. And now as they sell through some of that inventory, it should boost its cash flow from operations. Another good sign for investors looking to invest in Lowe's. Finally, let's look at its dividend per share annualized. So its annual dividend per share, and going back to before 2014 when the dividend per share was less than 80 cents, you could see very nice growth here in its annual dividend per share, rising all the way to $3 per share. So for those investors that bought Lowe's looking for a dividend in 2014, they're now getting a dividend per share that's almost 4 times or maybe 4 times as much as they were getting in 2014. So that's really the benefit of long-term investing in buying and holding for the long term, finding companies that have a protective business that can sustain themselves and grow revenue and profitability, execute well, and share those benefits with investors. And that's exactly what Lowe's has been doing, with its dividend per share rising from less than 80 cents to $3 per share. And so dividend investors of today can reasonably expect Lowe's to continue this upward trend longer term. May not be this fast and this explosive, but you can still reasonably expect dividend per share growth from Lowe's long term. Finally, let's look at its valuation to see if the stock is expensive. And I'm looking at the forward PE ratio, and Lowe's is trading at a forward PE of 14.5, about the average valuation it has traded for in the last year and a half or so. And on an absolute, when you compare with the S&P 500, a forward PE of 14.5 is not that bad. It's about a little bit below average, and that's to be expected considering that revenue growth could remain constrained, I want to say, in the first couple of quarters of 2023, as you know, people have already spent the money painting their homes and doing a lot of these home improvement projects. So revenue growth is going to be muted for the near term, but longer term you can expect you know, Lowe's to grow at its long run rate, which was around 7%. You can expect Lowe's to get back near that level over the next decade, but over the next year or two, it might be below trend. So to answer the question, is Lowe's an excellent dividend stock to buy for 2023? I'm going to say yes. You've got a good business delivering solid operating income growth, delivering solid revenue growth, delivering good executional improvements in an industry that's massive at close to $1 trillion, the home improvement industry, and it's growing. So, yes, I would recommend Lowe's as a dividend stock to buy for 2023 and beyond. Okay, so that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.